Welcome back. In our last video, we spent a bit of time looking at an introduction to companies. In this video, we want to dive a bit deeper into the reasons why people choose to form companies over other business entities and this idea of public and private companies. So to reiterate, a company is a for-profit organization that has its own legal entity. Now, typically, businesses choose to become a company because of one very appealing thing, that the owners of the business are legally separate from the business itself, and thus it gives the owners as well as the shareholders limited liability. As individuals, they don't risk ruining their lives by incurring the debts of a company. On top of that, there are also many other reasons why people prefer companies. Firstly, there's just the simple fact that the enhanced status of being a company is generally recognition that a business has been successful in its endeavors. In financial terms, selling shares is a good source of finance for businesses, especially one that is expanding and with growing working capital requirements. In other words, capital being money, companies that require more money as they expand. Being a company means stability. As a company is legally separate from its owners, if a shareholder dies or retires, the business continues. Now, this is not always the case. In the case of a small company, the death of a major shareholder can deal a big blow to the business. If that person is also an active executive in the firm, it can cause some major disruptions. Nonetheless, the business does not die and its legal existence continues. Someone else can just inherit its operations. Finally, as opposed to other forms of businesses, companies typically have a far better chance of getting further finance, such as loans from financial institutions and governments. For this reason, they are preferred by business owners that want to expand and make it big. So achieving company status is often a big turning point in the evolution of a business, especially if the business didn't start out as a company, but as a sole trader or a partnership. Up until that point, there would have been a lot of questions or concerns about the survival of the business and its continuity and growth. When you achieve company status, you have achieved stability. And so to take full advantage of being a company, the business will usually try to use the newfound advantages that being a company brings. For example, a business will try to have multiple investors and thus generate capital or money. At the same time, this usually means that the original business owner will lose some control over the business, or could even lose personal involvement in the company altogether. When a business becomes a company, its new owners, or the shareholders, may make the decision to hire executives to make all major decisions. And so the original business owner could now just be an investor and no longer a key player. That's losing control. A key example of this is what happened with Apple Incorporated during the 20th century. As the company was founded, Steve Jobs, you had Steve Wozniak and Ronald Wayne, they were the original business owners. But if anyone has seen the movie Steve Jobs, then you'll know that Steve Wozniak lost control over the business and was eventually kicked out altogether. At some point, as Apple grew, the shareholders started to appoint executives, and when things started to go south, they even kicked Steve Jobs out of the company. The original owners, in that case, who started the company, was no longer a part of the company. Now, they did eventually rehire Steve Jobs in 1996, but it just really shows the risk from a business growing too much. Even the original business owners are at risk of losing their control over the company's decisions. Next, looking at this point of a public versus a private company. Okay, when a business reorganizes itself into a company, it can choose to become either a private limited company or a public limited company. So what's the difference here, you're wondering? Well, the only real difference is that a limited private company can only sell shares to shareholders privately, to people known to the owners, such as friends or family or associates. For a private company, the number of shareholders allowed in total is generally quite low legally, with at max usually only being allowed 20 people. And this varies from country to country. The result or consequence of this is that becoming a private limited company limits the amount of finance that is available, but it allows you to have a lot more control over the business because there are fewer owners or shareholders. Private limited company doesn't mean small company. It just means limited investors. For reference, 7-Eleven in Australia, one of the biggest multinational convenience chains, is a private limited company. In Australia, this massive chain is privately owned by a few people, the Withers and Barlow family. If the business decides to go from a private limited company to a public limited company, which we typically hear the phrase as the company is going public, then it now has to offer its shares in a public place, like a stock exchange, based in one of the major financial centers of the country, such as New York or London, Tokyo, Shanghai, or even online, for example, Wall Street, the Nasdaq, etc. What this means is that now everyone or anyone can become an owner of the company. And if someone decides to take control over your business by investing in a large sum of money and becoming the biggest shareholder, they are legally allowed to do that. You can lose control of your business. Going public opens up the possibility of securing large amounts of money from financial loans. In 2012, we saw Facebook open up during its initial public offering, or IPO. This is another very important term, which is talking about the first time a company makes its shares public or for sale to the public. From that IPO, we saw Facebook acquire $16 billion in USD. Again, as I mentioned, when a company goes public, it does lose a lot of privacy. Public limited companies have to allow potential investors to see their financial accounts, which become open to everyone. So there is a lot more transparency and a lot of space for competitors to see what you're doing. Moreover, the business itself has no control over who buys their shares. A funny little thing is that in 1997, Microsoft actually bought $150 million worth of shares in Apple. The reasons are very convoluted. So let's call that there. We'll continue looking at for-profit companies in our next video. See you soon.